Hello guys, welcome to this video. In this video we'll be talking about whole life insurance policy, and we talk about what it is and talk about the advantages and the disadvantages of whole life insurance. um, to explain what whole life insurance is, I think you will have to get the basic components of whole life insurance. The basic components are three. We have the premium, we have death benefits, and we have the cash value. The premium is actually what you pay every month. It is from this premium that the death benefits will be derived, and that's where the cash value will be derived as well. Uh, the death benefit is simply the benefit that your beneficiaries will get upon your death. This is the money that goes into cost of insurance. Actually, this is money that goes into your beneficiary, maybe your spouse and or your children, as the case may be. And the cash value is simply some percentage of the premium that goes into, let's say, a savings. A savings. Let's say it's like what's it called? Um, just like a savings account. You are not literally the owner of the money actually, but the money is taken out of the premium. So your premium contains both the benefits and the cash value. Yeah, and the insurance company will not be paying into your cash value account until 5 to 10 years. Um, in that period, most of the money will be going into your debt benefits, and some will be in the admin fees and some commissions to the person that sold you or to the company that sold you the whole life insurance. So it is until after the 5 to 10 years that some money will be paid into your cash value account. And another thing you have to know about the whole life insurance is that your beneficiaries doesn't have we don't get the cash value. Whatever money is in the cash value account after your death, it simply goes to the insurance company. You get only the death benefits is the only thing that your beneficiaries will have access or will be given upon your death is the death benefit. Death benefit. So, and another thing that you have to know is that you have no say in the percentage of the premium that goes into the death benefit, the percentage that goes into the cash value. It's simply the insurance company that determines that. You don't have any control over the percentage of the premium that goes into any of those parts. And and the only way to get the cash value account is simply you closing the insurance account, the whole life insurance account. When you close it, that's the only time you can get back the cash value account, and in that case you will not be entitled to the death benefit. So this is one of the reasons why the whole life insurance scheme is not so many financial experts don't add to. You are simply paying for two different accounts, and after your death only one of the accounts will go to your beneficiaries. And even before you die, you decide to have one of the accounts, it is only one that will be given to you. You cannot have access to the two accounts that you've been saving money into all these years. So, but there's an advantage of the whole life insurance scheme, that you cash value account, the money that goes into the cash value account is non-taxable. Like, you are not paying any tax on that money. So far the money doesn't exceed the amount of money that you've paid. All these years you've been paying $100 every month for your premium, and the accumulation of the money of the premium doesn't exceed, it's like 100,000 grants. So, and your cash value account is less than 100,000 grants, you are not going to be paying any tax on that money. So the moment the cash value account exceeds 100,000 grants, then you start paying tax on that cash value account. And bear in mind that the cash value account increase. There's an interest rate of 1.5% to 2.2% annually on the cash value account. So it will be growing annually, and you will only pay tax if the money, the premiums that you've been paying. Obviously, the if you notice what I said about the interest rate, it's 1.5 to 2.2. If you think of it properly, 1.5 to 2.2 is pretty low interest rate that you can have in annual basis. So that's one of the another reason why so many financial experts advise against whole life insurance, so to speak. So with that, I believe by now you should understand what whole life insurance is. Simply you paying some premiums, and out of that premium, your death benefit will be taken out of the premium, and some the other remaining parts will go right into the casual account. And upon your death, your beneficiaries will only have access, will only be given the death benefits and not the cash value. Oh, another thing that you need to keep in mind that you don't have a say on the percentage of the premium that goes into your death benefits or the cash value. And the only way to get the cash value is by you closing the whole life insurance scheme account, which is not advisable, because when you do that, you only get the cash value benefit, and the death benefits we go right to the insurance company. So now the advantage of whole life insurance is that it's a coverage. It covers your whole life, like the name implies. Whole life insurance, you use it till you die, so to speak. And compared to like term, which is another term life insurance, this is another insurance scheme that we have a video on that on the channel. Please the description to learn more about time life insurance. In time life insurance, you specify the time range of the insurance. Let's say most people use 20 to 30 years. So with that, after that year, the insurance will close, insurance account will close, and all the money you have there will be paid to you. But in this case of whole life insurance, it covers your entire lifetime till you die. Another benefit of whole life insurance is that the cash value is not taxable so far it doesn't exceed the amount of premiums that you've paid. And another funny advantage, I said funny, I'll explain it afterwards, is that you can borrow against the cash value account. I said you or your beneficiaries are not you and your beneficiaries cannot get the cash value account, except if you close the whole life insurance scheme for yourself. So you can borrow this money, since you can't have it, your beneficiaries cannot have it either, but you can borrow this money. And to borrow it, there's something funny here, is that you still have to pay interest on the money after you borrowed it. That's crazy. Your money is being saved as a cash value. If you decide to borrow that money, the insurance company will still take some interest from you after borrowing your money, after lending you your money, so to speak. So it's kind of funny. Well, it's still an advantage. Rather, instead of you like just the insurance company will take it out, then give your beneficiaries the benefit. Before you die, you can borrow the cash value. And as you must have expected, there are several disadvantages of this whole life insurance. And here is that it is pretty expensive. Whole life insurance is very expensive compared to like other life insurance scheme like term life insurance. For example, in term life insurance, if you're paying like $10 in term life insurance. Whole life insurance and equivalent insurance in the whole life aspect will be like $100. So time life insurance is very expensive. Another thing is like in whole life insurance is that it's not flexible. For example, the premiums that you pay, you can't determine the percentage that goes into the death benefits account or the cash value account. It is the insurance company that determines that. And again, the cash value account is slow. Like I said earlier in this video, it is after like 5 to 10 years of you paying your premiums that you will have some money going into your cash value account. You will have to first like pay the commissions, the administrative fees, and then there will be obviously the debt benefit. It's after that, after like 5 to 10 years, that some money will now be going into your cash value account. And the last thing is that cash value doesn't go to your beneficiaries after you die. It is the insurance company that takes the cash value. This is absurd. It's absurd. So those are the explanations on subscribe to our channel. I will see you in the next video. Bye bye.